I don't see anyone else in the waiting room, so maybe it's a good time to start now. So good morning, good afternoon, good evening, everyone. Welcome to this second workshop on the BEPS two-pillar solution. Thank you very much for joining us. My name is Kaylin Onesco, and I'm a public management specialist in taxation at ADB. I'm also a member of the Asia Pacific Tax Hub. I'm joined today by two other colleagues, Renata Fontana, who's working sort of on the back room, collecting all of your questions, and Matt Andrew, who will be presenting the two-pillar solution to you today. A couple of house rules to go over first before I let Matt take the floor. So first, this workshop is being recorded. An email will be sent to all participants with this recording as well as the presentation. So we'll send this to you following this workshop. Second, please remember to rename yourself as shown on the screen. So your country or organization followed by your first name and last name. And this is important so that just in case we run out of time to respond to any of your questions, we know who to follow up with. Next, please keep your audio on mute. If you have any questions during Matt's presentation or during the question and answer session, we would ask you to use the chat function to type in your questions, and don't worry, we will respond to your questions. And then finally, following the question and answer session, we will present a QR code as well as a link to a survey. And we kindly ask that you give us your feedback on this workshop, as well as the workshop that was held on the 13th of May. So with that, without any further ado, I'll turn the floor over to Matt. Thank you.
Thanks very much. And yeah, let me just note we'll be going through Pillar 2 today. And if you remember the OECD two-pillar solution, Pillar 1 was the allocation of new taxing rights to market jurisdictions we went through last week. This is Pillar 2, which will be dealing with the global minimum tax at 15%. And so that's where globally a minimum tax rate of 15% will be set for all multinationals that are in the scope of Pillar 2. And so I'll give you a quick update of where we are in terms of progress of Pillar 2, and I'll refer to it as Pillar 2. We'll then walk through very briefly what was agreed by the Inclusive Framework in the October statement, then the how the rules work for the Pillar 2 globe rules, which I will define, and the subject to tax rule, which I'll also define, and then we'll do an example, and then we'll finish. Next slide, please. Yeah, so let's go firstly to the status update, and this slide, if you look to the right-hand side, we dealt with the left-hand side last week, and so the October OECD statement on BEPS 2.0 reconfirmed that 2023 as the implementation point for both Pillar 1 and Pillar 2. That timing of implementation for Pillar 2 for some Inclusive Framework members may be changing, but we're still not clear on what that is yet, so I won't make any further comments. What's happened so far on Pillar 2? We had the release of the globe model rules, and the globe model rules are the rules that mechanically implement the global minimum tax. So I'll refer to them as the globe model rules. And they were issued on December 2021. There are also the detailed commentary and examples were released by the OECD in the Inclusive Framework in March 2022. And they provide additional information relevant to the interpretation operation of the model rules. And those are the model rules which will be look to be implemented by member states and by jurisdictions in terms of the application and implementation of Pillar 2. As yet, we don't have detailed globe implementation rules. So we have the model commentary rules of how it all fits together, but we haven't got we don't yet have the implementation framework on how that will specifically be undertaken and implemented by jurisdictions. There was a public consultation, which I'll allude to a few weeks ago in April, in terms of the implementation questions raised by the Secretariat of the OECD, and I'll come back to this at the end. We're also waiting on the subject to tax rule, which is a new withholding tax, effectively on low taxed income for specific transactions. And that we're still waiting on the model rules and the multilateral instrument of how that will be implemented. And we're hoping for that sometime in mid-2022. So what does all this mean? It means we have quite a lot of the rules for Pillar 2 in terms of the commentary and how it works and examples, but we don't yet have information on detailed information on how it will be implemented, the filing requirements, the timing, and also rules around how the payments will be made, and specifically in relation to any safe harbor rules. So rules, which means that specific calculations don't have to be undertaken, and I'll come back to that as well. Next slide, please. So let me just walk through the globe model rules if we move to the next step. So these are the rules in a nutshell. So on Pillar 2, the framework of the globe rules and the subject to tax rule are really confirmed in the OECD statement and also in the model rules, which were released, as I mentioned, in December, and the commentary in March. So the multinational groups will be in the scope of the globe rules if they have euro 750 million annual revenue or greater for 2 of the 4 financial years immediately preceding the tested financial year. So say the rules were implemented in 2024, then in the 4 preceding years, you'd need at least 2 of the 4 years which were above in revenue at a group consolidated level above 750 million euro. And then if a multinational had that for 2 of those 4 years, it would be in the scope of the globe rules. The minimum tax rate for the purposes of the application of the income inclusion rule, which I'll go through, and the under tax payment rule, is confirmed as 15%. So that means that multinationals on a jurisdiction by jurisdiction basis need to have a tax rate of at least 15%. And so that obviously impacts multinationals that have tax incentives in jurisdictions which they might have service centers or principal structures or manufacturing incentives or R&D incentives. In the model rules, there are transition rules, and that's chapter 7 of the model rules, where there is also what's referred to as a substance-based carve-out, where you can offset, for example, in the first 5 years, 10% of the value of the tangible assets and payroll, and that's effectively allowed as a carve-out of income to reduce the income for the purposes of the application of the globe rules. So it's effectively an incentive. And then there's also a de minimis exclusion where multinationals, if they have jurisdictional revenue of less than euro 10 million and profits of less than 1 million, then the globe rules will not apply on a de minimis exclusion basis. The subject to tax rule, this will apply, as I've mentioned, where the nominal tax rate used against royalties, for example, and interest, and potentially other types of transactions is less than 9%. And so in that case, a developing country can look to apply the subject to tax rule, which I'll refer to as the STTR, effectively like a withholding tax. So as the royalty leaves, or as the transaction leaves a jurisdiction, going to a jurisdiction which has corporate income tax of less than 9%, for example, then a subject to tax, withholding tax, can effectively be applied on that low tax transaction. There is also an exclusion for the under tax payment rule in the initial phase where a multinational has a maximum of euro 50 million in tangible assets abroad in no more than 5 jurisdictions. So the under tax payment rule, which is the backup rule, which I'll come to, there's also an exception, a de minimis exception for that as well, and that's for 5 years when multinationals are starting up. And then lastly, for me, in terms of implementation, the globe rules initially in the October statement were to occur with the domestic law to be implemented in 2023 for the income inclusion rule, and in 2024 for the under tax payment rule. So in a nutshell, what we're doing is we're creating a minimum tax on multinationals on a jurisdictional basis of at least 15%. And there are some carve-outs and some de minimis rules around that. We're also potentially applying a subject to tax rule, effectively a withholding tax, on low tax covered transactions, which I'll come to in a minute. So low tax minimum tax and a low tax withholding tax, effectively, is in a nutshell. If we move to the next slide. So in terms of the implementation of this, I mean, this is complex. And so I'm just going to very touch on it little bits, overviews to give you a feel for it. But it is very complex, so I can't go through everything. But the primary rule in order to apply the minimum tax is what's referred to as the income inclusion rule, or what I'll now refer to as the IIR. And this is where the top-up tax is imposed by the ultimate parent entity on a constituent entity. And so where the income of a constituent entity, which is an entity within a multinational group, which is subject to the rules. And so in this particular case, we would say where the income of a constituent entity, for example, in Singapore or wherever it could be, whichever jurisdiction was only taxed, say, at 5%, then the ultimate parent entity, which is in country Y, could top up that income to 15%, so a 10% delta. And this requires the globe rules to be implemented in that country Y. Then under the undertax payment rule is a secondary rule. So say country X had not applied the income inclusion rule, then the secondary rule to tax this low tax income in country Y is referred to as the undertax payment rule, and I'll now refer to that as the UTPR. And so the UTPR will apply if the IIR, income inclusion rule, is not likely to be imposed due to the fact it is not legislated by a country. So in this case, for example, country X may impose the undertax payment rule, the UTPR, which means it may limit or deny deductions on intragroup payments or require an equivalent adjustment to the extent the low taxed income of a constituent entity in country X is not subject to tax under the income inclusion rule in country Y. And so that could be, for example, you could have, for example, an ultimate parent entity in country Y, but it decides not to implement the income inclusion rule. Then other jurisdictions which are connected to that group, which have high tax income above 15%, can look to actually tax that undertaxed profits in country X. And so it's a backup rule if the ultimate parent entity does not apply the primary rule, the income inclusion rule. There is an exception to this, which is the qualified domestic minimum tax, which applies first, where a jurisdiction could impose a qualified domestic minimum top-up tax on its resident domestic entities. And so this could be the case, and many jurisdictions are looking to do this, or potentially considering it, which is instead of having the ultimate parent entity pay the top-up tax for low taxed income in other jurisdictions, in those low tax potentially jurisdictions, jurisdictions are considering whether they should apply the qualified domestic minimum top-up tax so that they top up the tax of their resident entities, not the ultimate parent entity somewhere else, or have other high tax jurisdictions apply the undertax payment rule. And that's because jurisdictions want to actually capture that income themselves as qualified domestic minimum top-up tax in their own regime. And so that's something to be aware of. And I've already mentioned the subject to tax rule, which is to say that potentially it's a treaty-based rule. The subject to tax rule is treaty-based rule that allows developing countries to impose source taxation on covered payments between related persons that are subject to nominal corporate income tax rates of below 9%. And so the STTR will be creditable as a covered tax under GLOBE. And so when we step back from this, we go, the primary rule is the ultimate parent entity will top up any low tax income. When it hasn't applied a qualified income inclusion rule or legislated it, then potentially high tax other jurisdictions within the multinational group can look to apply the undertax payment rule to top up the tax. But if a jurisdiction in itself has looked to legislate a qualified domestic minimum top-up tax, then to 15%, then that will trump the income inclusion rule and trump the undertax payment rule, so that those rules cannot be applied, but the qualified domestic minimum top-up tax applies first. If we move to the next slide, please. Yeah, and so there are rules around how these will be applied. And so first we need to identify which entities are in the scope, are constituent entities, and what types of constituent entities. And this is important to determine where the top-up tax will be paid. And the rules for this are outlined in Chapter 1 of the model rules. So remember, a multinational group is within the scope of Pillar 2 if it has annual revenue of greater than 750 million on a consolidated group basis. And it's for 2 of the 4 preceding years. Now, a group is a collection of entities that are either related through ownership or control and included in the consolidated financial statements of the ultimate parent entity. So it's a control test, and it's included, the income's included within the consolidated financial accounts. Then you need to identify the constituent entities, and that could be companies, it could be permanent establishments. We need to identify the ultimate parent entity, and we need to identify any intermediate parent entities. And I'll come back to partially owned parent entities and minority owned parent entities. And then we also need to figure out which entities are potentially excluded, such as an investment entity, a real estate investment vehicle could be excluded as an ultimate parent entity. And then we also need to find the location of where the constituent entities actually are. So it's important to note the income inclusion rule is not always applied at the ultimate parent entity. And so it's important to identify the correct paying entities. And there are a series of steps to be undertaken to find these entities. And that's in Chapter 1 and Chapter 2 of the model rules. So first of all, we need to eliminate any excluded entities. And as noted above, the following entities are excluded regardless of whether they are the ultimate parent entity. So that's any governmental entities are excluded, international organizations, non-profit organizations, pension funds are excluded entities. Entities that are only excluded if they are the UPE, the ultimate parent entity of a multinational group, are excluded if they're investment funds or real estate investment vehicles. So once we've taken out our excluded entities, then we need to apply the ordering rule that operates through a top-down approach. So first of all, where is the top-up tax potentially paid to top up entities which are below 15%? Well, that starts with the ultimate parent entity. So if the UPE is not located, if the UPE is not located in a jurisdiction that has implemented the IIR, then the highest parent entity in the ownership chain that is located in the jurisdiction that has implemented the IIR will then operate as the intermediate parent entity and pay the top-up tax. So that could be, for example, you have a US ultimate parent entity, but the US has not applied the income inclusion rule. You would then look down the chain to the second highest intermediate parent entity and look to apply it there. Now, if that hasn't applied it, you keep on going down to see who can apply it, which entity can apply it, and which jurisdiction. Now there are exceptions to that top-down approach to apply the top-up tax, and this relates to partially owned parent entities, which will apply the IIR in priority over the controlling parent. And so this is, I'll now refer to a partially owned parent entity as a POPE. So a POPE is defined as a constituent entity that has an interest in another entity in the group and has more than 20% of its ownership interest in its profits held by persons which are not part of the group. So where you have a joint venture, or where you have a split ownership, and you have a group which is a non-related group which owns more than 20%, then you apply the POPE rule, and the top-up tax will be applied at the POPE parent entity level. The other exception on the right-hand side here is the minority-owned parent entity, the MOPE. And in this case, a separate group is actually created, and the top-up occurs at the MOPE level. And the MOPE is where a minority-owned constituent entity, where the ultimate parent entity has less than a 30% interest. So where you have 70+% owned by a non-related group, then you apply the MOPE rules and create a separate group for that group, and the MOPE you apply the top-up tax at the MOPE level. So let's now turn to the calculation itself. So what I've been through in terms of what's a constituent entity, what's a M&E group, how do I apply the top-up tax in order, ultimate parent entity, intermediate parent entity, POPE, exception, MOPE, exception. Those are all in chapter 1 and chapter 2 in terms of how you apply the mechanics of the income inclusion rule. Now let's turn to the calculation of the income inclusion rule, which are in chapters 3, 4, and 5. So let's go to the next slide. So I think it's useful here to see how the income inclusion rule is actually calculated, and it's in 6 steps. And I'm only going to go through this at a high level because this requires, it's very complex. So step 1 is we determine the globe income for calculating the globe income, which is in chapter 3. And the starting point is the income or loss as recorded in the accounts, and it's adjusted for various elements. And this will be at a jurisdictional level. So we take the financial income, accounting income of each entity in a jurisdiction, and then we make adjustments to get to our globe income. So we go from financial income to globe income with a series of adjustments to remove permanent differences, which I'll briefly go through. And then we consolidate that, we bring it up to a jurisdictional level. The second step is we determine the adjusted covered taxes for each entity in a jurisdiction. And so again, this is calculated at a jurisdictional level where we aggregate the covered taxes of all the entities in the jurisdiction. And so the starting point is the accrued current tax expense, which is then adjusted for a series of elements, including deferred taxes, which then seek to remove any timing differences. And so effectively we have, as part of this calculation, and this is now step 3, we take our covered taxes as the nominator and divide it by our globe income, which is the denominator. And that gives us our jurisdictional effective tax rate. And so when we divide our current taxes by our globe income, we get our jurisdictional effective tax rate. And that tells us whether we are below 15% minimum tax or above 15% minimum tax. So next we calculate the top-up tax percentage. And so this, for example, will go, is calculated for jurisdictions where the ETR is below 15%, as I've mentioned. Say, for example, it's 12.5%. We simply subtract the jurisdictional ETR from the 15% to actually get the quantum of the top-up tax. And that's step 4. Step 5. So now we've got our jurisdictional top-up tax. Is then we have to subtract from that what we refer to as the excess profits, and this is where we apply the substance-based carve-out that I mentioned earlier. And so we can take our globe income and then reduce that based on a carve-out for the value of payroll taxes and tangible asset carve-outs of each constituent entity in that jurisdiction. So the payroll carve-out is equal to 5% of a constituent entity's eligible payroll costs, and the tangible asset carve-out for a constituent entity is equal to 5% of the carrying value of the eligible tangible assets in that jurisdiction. So effectively, in transition rules, that's 10%, and going down to 5% over 10 years. And that's so we can reduce our globe income, our denominator, by this carve-out. And then the other thing we can do, and it's now in step 6, is we can then also look to see whether there's already a qualifying domestic minimum top-up tax which has already been paid. So it might be that actually under our ETR, under our calculation, we're only 12.5%, but then we get to step 6 and actually find, well, actually, this jurisdiction has applied a top-up tax to 15%, so there's no shortfall, and therefore no extra top-up tax to pay under the income inclusion rule. So that's a very brief outline of how that works, taking each constituent entity, finding out what their globe income is, their financial accounts with adjustments, their covered taxes, which is their current tax with adjustments, dividing covered taxes by globe income to understand whether there's shortfall, and then applying the carve-outs and seeing whether a qualified domestic minimum taxes have already been paid. So the globe income calculation is dealt with in chapter 3. The covered taxes calculation and adjustments is dealt with in chapter 4, and the actual calculation of the top up is dealt with in chapter 5, and the substance-based carve-out. Let's go to the next slide. Look, before we turn to any examples, just very quickly, I just want to very quickly touch on, there are significant amount of adjustments, and what multinationals are finding is that there are some very complex rules to apply, which means they're probably going to have to change their systems and find the data points in order to actually undertake these current calculations, and not all the information is currently dealt with in their tax provision, nor is it dealt with in their financial accounting. There is some other data requirements and elections which apply, which means new data and new calculations need to be undertaken in order to comply. So if we look at on the left-hand side here, I think that's dealing with, sorry, I'm completely blind. Yeah, we look at the left-hand side here, we look at globe income. This is dealt with in Article 3, as I've mentioned. So Article 3.1.1 requires that the computation of globe income or loss begins with a financial accounting net income or loss. Now, the financial accounting net income or loss is then defined, and it's the net income or loss determined for the constituent entity based on taking into account all the entity's income and expenses, including from transactions with other members of the group and including the income expense. So stated differently, the starting point for the globe income or loss is the bottom line net income or loss of the group entity before making any consolidation adjustments that would eliminate any intragroup transactions. We then need to look at what are the in general what the consolidated financial statements are, and whether they're acceptable financial accounting standards. So the globe rules then talk about acceptable financial accounting standards in 3.1, Article 3.1, which means financial IFRS, and includes, for example, Australia, Brazil, Canada, members of the European Union, members of the European Economic Area, Hong Kong, China, Japan, Mexico, New Zealand, the People's Republic of China, the Republic of India, the Republic of Korea, Russia, Singapore, Switzerland, the UK, and the US. And so it does need to be dealt with in terms of whether, for example, a group and a group UPE is in a jurisdiction which applies an acceptable financial accounting standard, and that's quite important. And then there are a series of adjustments in Article 3.2 which are made to globe income or loss. And so once the financial accounting net income or loss of a constituent entity is determined, it's adjusted for certain book to tax differences, and that's the differences between financial accounting results and the taxable income results that are common, and includes a framework jurisdictions. And so differences between financial accounting standards and tax accounting rules generally can be categorized as giving rise to either permanent differences that will not reverse in a future period or temporary differences that will reverse in a future period. So the adjustments required in Article 3.2 are generally related to permanent differences between the treatment required under the financial accounting rules and the local tax rules. And the temporary differences are addressed in Chapter 4. And you can see on the blue box there, these are the types of adjustments which are required. For example, excluded equity gains or losses, included revaluation method gains or losses from the disposition of certain assets, asymmetric foreign currency gains or losses, policy disallowed expenses, prior period errors and changes in accounting principles, accrued pension expenses are permanent differences which are then excluded from the globe calculation. On the right-hand side is the covered taxes, and as noted, the adjustments to the covered taxes is made in Chapter 4 and deals with the timing differences between the book to tax differences. And so the starting point is the current tax expense accrued in the financial account, net income or loss. And so there are a series of adjustments which are required. For example, cover taxes accrued as an expense is added back in the profit. Adding back a credit or refund of a qualified refundable tax credit, adding a global loss DTA, deferred tax asset that is used under the global loss election, and then deducting certain expenses with respect to income excluded from the computation of globe income or loss, deducting credit or refund in respect of a non-qualified refundable tax credit, etc., and so on. And so there's also So there are a number of additions and subtractions to get to the adjusted covered taxes. There's also the total deferred tax adjustment amount. And so total deferred taxes is adjusted to 15%. So the model rules effectively address temporary differences or timing differences through the total deferred tax adjustment amount, which starts with the deferred tax expense accrued in the financial accounts with respect to covered taxes. And then the deferred tax expense is required to be recast at the 15% minimum rate if the applicable tax rate is above the minimum rate. And then it's subject to a number of specified exclusions and adjustments. So it's complex, and the calculation itself takes a lot of time to get through. So there are dozens and dozens of data points which will be needed to undertake this calculation for multinationals and to be reviewed by authorities. Let's move to the next slide. So if for example, the income inclusion rule, which we've been through, and so with the income inclusion rule, we went, right, okay, let's look at let's look to see what are the different constituent entities of the group. How does the income inclusion rule apply? Ultimate parent entity, intermediate parent entity, POPE or MOPE. Then we have to go through the calculation itself in chapters 3 to 5 to figure out whether a jurisdiction is above or below the minimum rate. And it requires us to calculate globe income, where there's a number of adjustments from the financial accounting income and the current tax, which is adjusted, as I've mentioned, including for deferred taxes to get to an answer. And we apply the carve-outs, and then we understand whether there's already been a qualified domestic minimum top-up tax applied, which means we don't actually have to apply the income inclusion rule. Now, if the income inclusion rule is not applied for that because the UPE or intermediate UPEs have not actually legislated the income inclusion rule and there's no qualified domestic minimum tax, then potentially the undertax payment rule as the backstop mechanism will apply. And so the backstop mechanism this is the secondary rule and serves as the backstop to the income inclusion rule, as I've mentioned. And this can be applied by jurisdictions of the M&E group, constituent entities of an M&E group, which are higher tax jurisdictions. And so a jurisdiction's undertax payment percentage is determined on two factors, which with each given equal weight. And so this is how constituent entities can look to apply the undertax payment rule to other constituent entities which are lower tax. It's like a lolly scramble, effectively, to make sure that even if the income inclusion rule is not applied or the qualified domestic minimum tax is not applied, other high tax jurisdictions can look to apply it. Now, the percentage and how they pro rata, which percentage of top-up tax they take. So constituent country X might take 20%, country Y might take 30%, country Z might take 15%, is based on this UTPR factor. And so it's effectively applying is the employee factor, which is the number of employees in that jurisdiction relative to the overall number of employees in UTPR jurisdictions. That's one factor. And the second factor is the tangible asset factor, which is the net book value of the tangible assets in that jurisdiction applying the UTPR relative to the total number of jurisdictions which are applying the UTPR. And so there are a number of issues here. For example, tangible assets includes tangible assets for all constituent entities resident in the relevant jurisdictions. Tangible assets do not include cash or cash equivalent intangibles or financial assets. And then the number of employees for the purposes of this calculation means the total number of employees on a full-time equivalent basis for all constituent entities resident in the relevant tax jurisdictions. And for this purpose, independent contractors are also reported as employees as well. Next slide. Yeah, so as originally proposed under the OECD Pillar 2 Blueprint in October 2020, the UTPR applied to specific intra-group payments made directly to group members in low tax jurisdictions. However, in the Pillar 2 model rules, which were released in December 2021, the allocation key is no longer dependent on intragroup payments. Rather, the undertax payment rule is a formula. It's effectively a formulary apportionment approach to dividing up undertax payment profits among group entities. So the amount of UTPR top-up tax that is allocated to a UTPR jurisdiction is calculated by multiplying the total UTPR top-up tax amount by the jurisdiction's UTPR percentage, which I've just been through. But in short, effectively, what happens is high tax jurisdictions which apply the UTPR rule to lower tax constituent entities are really in a formulary apportionment based on their percentage, and that's the total percentage of headcount, payroll, intangible assets versus other group members. So let's now move to the application of the GLOBE rules. And to STTR, so let's go to the next slide. So this is an example that I put together here. So this slide deals with the ETR calculation and is steps 1 to 3 of the steps that I mentioned. So remember, the GLOBE rules calculated the effective tax rate of a jurisdiction by dividing the adjusted covered taxes, which is the nominator, in a jurisdiction by the net GLOBE income in a jurisdiction, which is the denominator. And remember, I took you through all those very briefly, those adjustments. So remember, GLOBE income is the financial accounting income with the adjustments we discussed. And the net GLOBE income is the GLOBE income of all constituent entities in that jurisdiction minus any GLOBE losses in those jurisdictions. And then adjusted covered taxes of constituent entity includes current tax expense accrued to its financial accounting net income or loss with adjustments and allocation rules I described earlier. So in this example, we see the adjusted covered taxes is 500 and the net GLOBE income is 4,000. And you can see that down the bottom here, where you've got net GLOBE income is 1,000 for DCO 1, it's 1,000 for DCO 2, it's 1,000 for DCO 3, it's 1,000 for DCO 4. And then we've got adjusted covered taxes in this jurisdiction, country D, of 250 for DCO 3 and 250 for DCO 4. So we aggregate that together and we say our nominator is 250 plus 250, so we get 500 for covered taxes divided by our net GLOBE income in country D, which is 4,000. And so we go 500 divided by 4,000 gives us an effective tax rate for the country of 12.5%, which is below the minimum rate. And so in this particular case, country D will need to be topped up tax. And in this case, we would top up the tax potentially in country A, or potentially in country C, as country A as the UPE, the ultimate parent entity, or country C, which is potentially an intermediate ultimate parent entity for the purposes of the GLOBE rules. Next slide, please. Okay. So calculating the top-up tax. So this slide deals with the top-up tax. So now I'm in steps 3 to 6 in the earlier slide I showed you on the calculation process. So for example, step 4, we subtract the jurisdictional ETR of 12.5%, which I just went through. And so this is now, we know that 12.5 less 15% means we've got a top-up tax rate, minimum tax of 2.5% that needs to be topped up. Step 5 is then we then calculate the excess profit. So we do this by subtracting the net GLOBE income from the substance-based income exclusion, which I just went through. So remember, we've got a substance-based exclusion for headcount, payroll, and assets. And so remember, the substance-based exclusion is broadly 5% of eligible payroll costs plus 5% of eligible tangible assets in the relevant jurisdiction can use to be offset the GLOBE income. We then, step 6, we then deduct the qualified domestic minimum top-up tax if there was any applied and in this case, there is no qualified domestic minimum top-up tax. And these 3 steps allow us to calculate the jurisdictional top-up tax. So in this example, the jurisdictional top-up tax is 100. So I take my 4,000 globe income times 2.5%, which equals 100. And this assumes a 0 substance-based income exclusion carve-out and a 0 qualified domestic minimum tax. But in a complex example, we would need to adjust for the substance-based carve-out or even top up to 15% with the domestic minimum tax. And then we need to allocate it per jurisdiction as well. So the top-up tax per constituent entity, DECO 1 is 1,000 divided by 4,000 times 100, which equals 25 top-up tax for DECO 1. Same for DECO 2, same for DECO 3, and same for DECO 4. And so we allocate the top-up tax based on a proportionate basis where we go the constituent entity net globe income divided by the jurisdictional net globe income times the top-up tax equals the top-up tax per constituent entity. And so that's very simply how we would look to apply these rules to top up the tax either at country A or country C. Let's now quickly just turn to how we apply as an example of the subject to tax rule. So the subject to tax rule, if we go back to the previous slide, is a treaty-based rule that allows developing countries to impose limited source taxation on covered payments, and that's between related people, and those payments which are likely to be subject to a nominal corporate income tax rate below 9%. And so that the STTR will also be creditable as a covered tax under GLOBE. So in this example, country D and country E have implemented the subject to tax rule in their bilateral tax treaty. So ECO 1 makes 1,000 in annual payments to DECO 1, and you can see that here. These payments could be on interest potentially or royalties, and so we're still waiting for guidance from the OECD in terms of the exact what are the covered taxes, sorry, the covered transactions where we can apply. Firstly, an M&E would need to determine whether the payment is in the scope of the subject to tax rule, and as I've mentioned, that's likely to be interest and royalty payments, but perhaps not cost of goods. But we need to see where that discussion goes. Next, the M&E will need to determine the nominal tax rate on the payment applied by country D to the payment. And so in this example, the nominal tax rate on the payment is 0%. And so under this example, the STTR will likely to be applied as follows. ECO 1 may subject the gross payment to 9% withholding tax, as this is the difference between 0% nominal tax rate to the 9% STTR rate. And so accordingly, DECO 1's covered taxes increased by 90. And you can see that here. And so as a consequence, the country D's globe ETR now moves from 12.5% to 14.75%, which is 590. Remember, we had 500 divided by 4,000. Now we can also credit the subject to tax payment. So it's now 590 as a covered tax divided by 4,000. And so a small amount of the top-up tax will still be required under the GLOBE rules because it's still slightly under the 15% minimum tax. And so what next for Pillar 2? Let's move on to the next slide. Yeah, so the model rules in the commentary are intended to be used by governments in incorporating the global minimum tax into their domestic legislation. So in this regard, the inclusive framework is now working to develop an implementation framework to provide guidance on coordination, administration, and compliance matters with respect to Pillar 2, global minimum tax. However, the timeline laid out in the October statement contemplates that the implementation framework may not be released until the end of 2022, which would immediately potentially precede the anticipated entry into effect in 2023. In the public consultation for the implementation framework, the OECD asked 4 questions, which it is seeking public comment on. So the first question, do you see a need for further administrative guidance as part of the implementation framework? And if so, specify the issues that require attention and include any suggestions for the type of administrative guidance. Second question, do you have any comments in relation to filing, information collection, including reporting systems and record keeping? And in particular, do you have any views on how the design of the information collection, filing obligations, and record keeping requirements under the GLOBE could be designed? Third question, do you have any suggestions on measures to reduce compliance costs for M&Es, including safe harbors? And then fourthly, do you have any views on mechanisms to maximize rule coordination, increase tax certainty, and avoid the risk of double taxation? So on the questions of further administrative guidance, the OECD Secretariat indicated that many stakeholders stressed the need for further clarity on the legal status of the commentary, the release of guidance on a rolling basis, and guidance on the interaction of the US global intangible low taxed income regime, the GILTI regime, with the GLOBE rules. And in addition, the Secretariat noted that the comments letters raised issues with respect to a range of other topics, including transfer pricing adjustments, tax credits, and deferred tax accounting. On the question of information collection and reporting, the OECD Secretariat noted that the common views expressed by stakeholders included the need for standardized GLOBE information request, centralized filing, an effective exchange of information framework that would include a qualifying competent authority agreement to provide data safeguards, confidentiality, and appropriate use conditions, and a grace period during which good faith mistakes should not trigger any penalties. On the question of safe harbors, the OECD Secretariat indicated that the common views expressed by stakeholders included a request for a safe harbor based on the country-by-country reporting data, and a mechanism that would ensure that no effective tax rate calculations would be required for jurisdictions that have a qualified domestic minimum top-up tax. On the questions of rule coordination and tax certainty, the OECD Secretariat indicated that the common views expressed by stakeholders included the need to develop a centralized process conducted by the inclusive framework to determine whether a rule is considered to be qualified, establish a coordinated approach for audits, and develop an early certainty process, and introduce a binding dispute resolution mechanism founded in a multilateral convention. And so you can see that there's a lot of really important questions in terms of the administration coordination and also dealing with dispute resolutions or disputes in relation to the application of the income inclusion and the undertax payment rule. We're also obviously looking forward to further information coming out in relation to the STTR, the subject to tax rule, which we're hoping will receive draft documents sometime in mid-2022 in relation to those rules and the potential multilateral instrument as well. And so that's it from me in terms of a very high level Pillar 2 overview, which obviously is very, very complex, but we look forward to further engagement with you on this. And that's back to you, Kayleen and Renata.
Thanks very much, Matt, for that very comprehensive discussion of a very complicated topic, which I know that you could spend hours discussing. If anyone has any questions for Matt, please type them into the chat box. We don't have any questions yet, but I'm sure they're coming. Maybe while we wait for those questions to come in, Matt, would you like to talk a little bit about what ADB can do to help our DMCs who need some assistance with the 2-pillar solution?
Yeah, actually, I might, if it's okay, I'll speak under the control of Renata here. So maybe Renata, if you want to kick that discussion off, I'm happy to support that discussion.
Sure, thank you. So I guess we have our regional technical assistance on enhancing tax transparency for developing member countries. We can provide assistance in various forms under this program. For example, we can conduct assessment needs, and we can also conduct in-country operational activities once those needs have been identified. we can promote regional dialogues as the one we will have coming up soon on June 2nd with our other development partners, the OECD, CATA, PITA, and SIGATAR, particularly on this topic and other international tax developments. You're all invited to attend that meeting. You will receive more information via email once this session is over. And we can also conduct skill development activities like trainings, workshops, and that can be done both on a regional level as well as bilateral level. So if you're interested in any of those modalities of technical assistance, please reach out to us. I will post our email address from the tax reta on the chat box, and we'll be happy to follow up with you. I think in the meantime, we got a question, so over to you, Kaylin.
Thanks, Renata. Yeah, so we received one question. So the question is, can the low tax jurisdiction apply IRR or the UTPR rule to get the top-up tax of other LTCEs?
So do you mind just repeating that question, Kaylin?
Yeah. Can the low tax jurisdiction apply IIR or the UTPR rule to get the top-up tax of other LTCE?
Yeah, so typically it would be if a jurisdiction, an ultimate parent entity was, or an intermediate parent entity was low tax, potentially it could apply to group level the the IIR rule, but it would also be subject to UTPR itself. So if you're an ultimate parent entity, then potentially yes, but you would also have to top up your own jurisdiction as part of that process. And then second of all, a low tax jurisdiction wouldn't be able to apply the undertax payment rule. So it's for those jurisdictions above the 15%.
We have another question. If the jurisdiction, a development country, sorry, let me start again. If the jurisdiction, a developed country, is not a member of the BEPS inclusive framework, can it join Pillar 2 and levy the minimum corporate tax rate for MNEs that provide distance services to individuals of the jurisdiction?
Yeah, I mean, I think that's the case, and I mean, in terms of because I think it's important to recognise here that even if a jurisdiction decides not to apply the income inclusion rule, decides not to apply the undertax payment rule, or decides not to apply a qualified domestic minimum tax, that does not mean that entities within its jurisdiction are not subject to aspects of the globe, the application of the income inclusion rule or the undertax payment rule somewhere else, or the subject to tax rule. And so I think the answer is yes. I think because at the end of the day, I think the legislation on how this will be implemented will be domestic rules. So it's different. It's actually different to Pillar 1. Remember in Pillar 1, for some of you who attended, I talked about the multilateral convention, and it'll be implemented through a multilateral convention, whereas really a qualified income inclusion rule, a qualified domestic minimum tax, a qualified undertax payment rule will really be implemented through the domestic rules of a country. And the question then becomes, as I mentioned in the end, is whether it qualifies through that peer review process. And so jurisdictions which are currently non-inclusive framework members are thinking about this, saying, well, I think I would like to apply a qualified domestic minimum tax, or I would like to apply an income inclusion rule, because if I don't top up tax my domestic resident entities in my jurisdiction, then some other country will. So I might as well look to apply those rules to top up to my 15% by legislating those rules. So I think it's a very good question. And as I mentioned, what's qualified and not qualified in terms of those rules is still yet to be determined through the OECD implementation rules, which are due out at the end of 2022.
Thanks, Matt. Another question for you. Do you foresee the CFC and other BEPS action measures overlapping minimum tax framework to be removed in the future? This is when the minimum tax is fully functional.
Yeah, I mean, that's an excellent question. And I probably need to think about it a little bit. I need to think about it a little bit because the rules in terms of the ordering rule is not yet quite clear in terms of what comes first, what comes second, what comes third, what comes fourth. So, for example, does the CFC rule apply first? And you would apply that first to top up, and then if you're still below that calculation, because remember all the CFC rules they apply under our current international tax rules. And the globe calculation and the current and the adjusted cover tax calculation have all these adjustments, which means you get these really sometimes unexpected outcomes, or even maybe slightly unintended. You can because of by removing permanent differences, it can really impact. You thought you were above 15%, you might actually be below, for example. And so I think the way the rules will potentially work, the way we're interpreting them in some ways, is that the CFC rules should apply first, and then you apply the rules for the top-up tax. But it's an excellent question, because I think there are different people currently thinking about that differently, and we are looking for further guidance from the OECD Secretariat on that. It's a very good question.
Thanks, Matt. I don't see any further questions in the chat for you. Maybe we'll just give people a couple of seconds to see if there's any other questions. If you want to ask your question, please type it into the chat. Similarly, Danny has just posted a QR code on your screen. This is to access the survey, which you could provide your feedback to this workshop to let us know what you thought. We would very much appreciate your feedback. So I don't see any other questions in the chat. I guess if we don't have any other questions, the email address where you can contact us if you have questions has been posted in the chat, as well as email addresses on the screen. So I guess we will end here for today. So thank you very much for joining us for this workshop. As I mentioned earlier, this meeting has been recorded, and we'll be sending this recording to you, as well as the slides that Matt presented. So expect that email shortly. We'll also be sending a link to the survey in that email. And again, if you have any questions for Matt, Renata, or myself, please feel free to contact us. So thank you very much again for joining us, and we will talk to you soon. Thank you.
Thank you.